The reason most people with a low credit score never start the mortgage process is because they believe a lie. And the lie is so widely repeated that even the people who believe it have never actually checked to see if it's true. My name is Justin. I'm not your typical CPA. I focus on business growth and finance. Let's go. I'm going to ask you something, and I want you to be honest with yourself. How many times have you typed into Google, "Can I buy a house with a 580 credit score?" And how many times did you close the browser frustrated without doing anything? Because you already decided in your mind that the answer was no. I know, because I talk to people in this community every single week who have been sitting on the sideline for years, and not because they can't qualify, but because someone, a lender, a family member, a random comment on the internet, told them that their score was too low to even try. Here's what they didn't tell you. Pre-qualification requires soft credit pull. Soft pull means your credit score does not go down, not a single point. You can walk through the entire pre-qualification process today. Even at a 540, 560, or a 580, your credit score will be exactly the same when you're done as when you got started. You've been scared of a process that cannot hurt you. And I'm going to prove it today, step by step, exactly how to do it. Check it out. Here's the conversation that happens in every household in America at least once per month. One person says, "We should look into buying a house." The other person says, "Our credit score is too low, right?" Then the first person says, "Well, how low?" The second person says, "I don't know, like 580 or something." The first person fires back, "Well, we can't do anything with that." And then they go back to scrolling Instagram while paying $1,800 a month in rent to someone else's mortgage. Nobody actually checked. Nobody actually called a lender. Nobody got pre qualified. Nobody looked at what FHA actually requires. They just agreed that 580 was too low based on nothing and moved on. That's not a credit problem. That's an information problem. And information is what I do. So you've been paying $1,800 a month to build someone else's equity because you assumed you couldn't qualify without ever actually asking. That assumption has cost you more than the down payment ever would have. Before I walk you through exactly how to get pre-qualified with a low score, you have to understand the difference between two things that sound the same but are completely different: pre-qualification and pre-approval. Most people use these words interchangeably. They are not the same thing, and confusing them is the reason thousands of people with low scores never start. Look at that table. Pre-qualification has zero credit score impact. It's a soft pull. It's invisible. You can get pre-qualified with a 540 score, and the lender will give you a ballpark of what you could borrow without touching your credit. Why doesn't everybody know this? Because lenders want you to go straight to pre-approval. That's how they capture your application. That's how they get the hard pull locked in. Pre-qualification is the step that lets you shop around before they shop you around. So here's the power move. Get get pre-qualified at 3 different lenders before you apply anywhere. Zero credit score impact. 3 different estimated loan amounts. 3 different lenders to compare to. You walk away knowing exactly which lender is offering the best terms without a single point dropped from your score. Most people get pre-approved by the first lender they talk to, lock in a hard pull, and then wonder why they're getting spam calls. Shop pre-qual first. Pick your lender, then get pre-approved. One hard pull, maximum information. Here's the 6-step pre-qualification playbook for low credit scores. This is exactly how to do it. Here's the exact sequence, 6 steps in this order. Do not skip steps. Do not reverse the order. This is the sequence that turns "my score is too low" into a pre-qualification letter in your inbox. Follow the steps. Step 1, know your actual score, not the one the app shows. Before you talk to a single lender, you need to know what score they're going to see. And here's the problem. The credit score on your Credit Karma app and the score a mortgage lender pulls are almost never the same number. Credit Karma shows your Vantage score 3.0. Mortgage lenders pull FICO score 2, 4, and 5, the three bureau specific versions. And then they use the middle score, not the highest, the middle one. So here's the action. Go to myfico.com. Pull your FICO score 5, that's your Equifax mortgage, FICO score 4, that's your TransUnion mortgage, and FICO score 2, which is your Experian mortgage. The middle of those three is what the lender sees. If that middle score is 580 or above, you qualify for FHA at 3.5% down today. Now, I've talked to people who thought they were at a 540 and found out their mortgage FICO was 592. The app was lying, not maliciously, just using a different model. Know your actual number before you walk into any lender conversation. Now, Credit Karma shows your Vantage score. Mortgage lenders use FICO. It's like showing up to a soccer game with a basketball. Same sport? No. Same result? Absolutely not. Step 2, check all 3 credit reports for errors before any lender sees them. This is the single highest leverage step in the entire process, and it costs $0 and takes 30 minutes. At 580, there's almost certainly something wrong on at least one of your 3 consumer reports. Wrong dates, duplicate collections, accounts that aren't yours, balances that don't match. The Fair Credit Reporting Act says any inaccurate entry must be removed, not updated, removed. And a removed collection is worth 10 to 50 times more than a zero balance update. So here's the action. Go to annualcreditreport.com, pull all 3 reports for free. You can get 1 per bureau per week through 2026. Circle every entry with a wrong date, wrong status, wrong amount, or wrong creditor name. Those are your dispute targets. Fix before the lender sees your file. If you watched my video on paying off collections, how it doesn't move your score, you already know. The collection entry stays even after you pay. That entry is what the lender is reading. A dispute that removes it changes your entire profile. One client in our community found 3 accounts on her report that weren't hers, disputed all 3, removed all 3. Then her score went from 572 to 641. Pre-qualified that same week. 30 minutes, $0, life-changing results. Step 3, find out which scoring model your target lender uses before you apply. This is the step that almost nobody knows to take. And after April 22nd, 2026, it's the most important question you can ask a lender before the conversation. Lenders now have 3 choices for mortgage credit scoring: Classic FICO 2, 4, and 5, Vantage Score 4.0, and eventually FICO 10T. Different models, different scores, same person. If you've been paying rent on time, Vantage Score 4.0 could score you 40 to 60 points higher than Classic FICO, because Vantage Score 4.0 counts rent payment history. Classic FICO ignores it completely. 21 lenders are already using Vantage Score 4.0 as of May 2026. If your Vantage score is 623 and your FICO is 578, you want to find a Vantage Score lender. That single question determines whether you get pre-qualified or turned away. So which credit scoring model to use for FHA pre-qualification? Classic FICO 245, Vantage Score 4.0, or FICO 10T? If the lender doesn't know the answer, that's information too. A loan officer who can't tell you which scoring model they use is a loan officer who hasn't been trained on the new rules. Find one who has. The lender you choose matters in 2026 more than it ever has. 2 lenders, the same file. different scoring model, completely different results. Ask the question. Step 4, start with pre-qualification at 3 lenders, soft pull only. Now you know your actual score. You've cleaned up any errors. You know which scoring model each lender uses. Now and only now you start talking to lenders, but not for pre-approval. For pre-qualification first, soft pull, zero impact. Pick 3 lenders that match your profile for a low credit score. You want to look at FHA approved lenders. Start with the ones who accept the scoring model where your score is the highest. The pre-qual question to ask every lender. 1. What's your minimum credit score for FHA pre-qualification? 2. Which scoring model do you use? 3. Can I get pre-qualified without a hard credit pull first? 4. What's your DTI limit for FHA? DTI is debt to income. 5. Do you have any down payment assistance programs? The lender who says yes, we can do a soft pull pre-qual first is the lender who respects your credit. The lender who immediately pushes for a full application and hard pull before giving you a single number, that's the lender optimizing for their capture rate, not for your success. Thank them and move on. Step 5, use compensating factors to offset the low score. This is the secret that changes everything for people who are at 540 to 579. Below 580, FHA technically requires 10% down, but FHA also recognizes something called compensating factors. These are additional strengths in your profile that reduce the lender's perceived risk even when the credit score is below the standard threshold. The lender has to look at your whole file, not just the score. A low score with strong compensating factors can get you approved, where a low score alone would get you denied. So here's compensating factor number 1, a larger down payment. A 10% down versus 3.5% tells the lender this person has skin in the game. They've saved, they're committed. The risk of default goes down significantly when the borrower has more equity at the start. If you can get the 10% down, even at 540, lenders have options. Compensating factor number 2, low debt to income ratio. This is your DTI. If your monthly debts are less than 30% of your monthly income, that's a compensating factor. The standard FHA ceiling is 43% DTI. If you're at 28% DTI with a 560 score, you're at better risk than someone at 41% DTI with a 640 score. The score is the headline. The DTI is the body. Underwriters read both. Compensating factor number 3, reserves. This means cash after closing. If you have at least 3 months of mortgage payments sitting in your bank account after you close, that's a compensating factor. It tells the lender even if something goes wrong, this person has a cushion. Reserves are one of the most underused tools in a mortgage approval at low credit scores. Compensating factor number 4, rent payment history with documentation. 12 months of on-time rent payments, documented and reported, is a compensating factor in manual underwriting. It says this person has been paying mortgage equivalent expenses on time for a year. VantageScore 4.0 already counts this in the score itself, but even lenders using classic FICO can use documented rent history in manual underwriting. Compensating factor number 5, stable employment. This means 2+ years. The same job, the same employer, 2 or more years. That's stability. Underwriters love stability. A 560 score with 5 years of the same employer is a different risk profile than a 580 score with 6 months at a new job. Stability is a compensating factor. Longevity is a compensating factor. Loyalty to one employer is a compensating factor. So here's the play. Before your first lender conversation, write down your compensating factors: DTI, down payment percentage, reserves, employment history, rent payment documentation. Walk into the lender conversation with your compensating factors on paper. You're not begging for an exception. You're presenting a complete case. Step 6, get pre-qualified, then protect your file until pre-approval. You've done the prep, you've cleaned the report, you've chosen the right lender. You presented your compensating factors. You've gotten your soft pull pre-qualification letter. Now and only now do you go to pre-approval. One lender, one hard pull, your best option based on what you learned in steps 1 through 5. But here's the catch. This ties directly into the last video. From the moment that hard pull happens to the day you close, your file is frozen. No new credit, no new debt, no job changes, no large deposits, no closed accounts. You know the rules. You watched the last video. Now you execute them. So here's in week 1, we pull our mortgage FICO scores. We review all 3 credit reports for any errors, and we fix them before the lender sees the file. In week 2, we dispute inaccurate entries. We remove negatives before scoring. Week 3, we start rent reporting if not active. We feed our Vantage Score 4.0 model. Week 4, pre-qualify at least 3 lenders, soft pull only, 0 credit impact, find the best option. Week 5, select the best lender, submit for pre-approval, 1 hard pull, maximum information. Week 6, our pre-approval letter in hand, now we start house hunting. Freeze your file, don't make any changes. So here's the big picture. Let me zoom out. Right now in 2026, of first-generation home buyers, people whose parents never owned a home, are navigating this process completely alone. No family knowledge, no neighborhood wisdom, no one to call and ask, is this lender good? Is this rate fair? Can I even qualify? They're 25 years old, making $80,000 a year, carrying 0 debt, and they don't know where to start. It's not a credit problem. That's an equity gap, and it's not accidental. Homeownership is the single largest wealth building mechanism in America. The median net worth of a homeowner is $396,000. The median net worth of a renter is $10,400. The gap doesn't come from smarter investing. It comes from owning versus renting. The people who stay in that gap, not because they couldn't qualify, but because nobody told them how to start, that's who this community exists to serve. The black family in Memphis who's been told your credit is too low without anyone explaining that pre-qualification is a soft pull. The Latino couple in Phoenix who thinks they need a 700 score when FHA accepts 580. The veteran in Tampa who doesn't know his documented rent history is a compensating factor. They're not locked out. They're misinformed. And that ends right now. So you can see it's still possible to qualify for a home loan with a low credit score. You're not out of the loop. You haven't even tried yet. That's the problem. So just remember, if you've gotten any value from this video, drop a comment in the chat, hit that like button, smash that subscribe button, leave a comment. It helps the algorithms, and this is to your success. Salud.